Hello and welcome to the second of two videos which make up this quarter's investment update. In the first video we looked at what's been happening in the economy and in markets, focusing in particular on what's been happening in the US, where Trump's tariffs and things like AI and monetary policy have been really driving markets all around the world. But pleasingly this year, pretty much every asset class that we invest in has gone up, and that's positive of course for portfolios which have all gone up so far this year as well. As you can see from the written report, the core portfolios of Cautious, Balanced and Adventurous are all up strongly, between about 6.3% and 7.8% so far in 2025. And perhaps that's quite surprising actually, given everything that's been happening. You know, it's pretty pleasing, but we are trying to take steps to try and bank some of those gains and guard against any pullbacks after such a strong run, more of which in a moment. But as usual, although we're talking a lot about short-term factors, we have to remember that investing is meant to be for the long term. So as usual, we'll start by looking at what long-term returns have been like. So this table shows the returns of our core portfolios over the last 10 years. In the written report, there is much more detail about all of the portfolios as well. But from this table, you can see all the portfolios are up over 10 years. Cautious is up nearly 54%, Balanced over 64%, and Adventurous up 87% over 10 years. That works out as a compound annual return of 4.4%, 5.1% and 6.5% per annum respectively. Now, as usual, there are two main benchmarks we can use for comparison. Firstly, there's the typical mixed investment fund that has between 20 and 60% in the stock market. Now, those have returned 57%, which is slightly more than our Cautious strategy, but below Balanced and Adventurous. Now, remember, our Cautious strategy tends to sit towards the lower end of that equity range, so we'd expect it to lag when stock markets are going up strongly, but hopefully it will fall less when stocks fall, whereas Adventurous is designed to do the opposite. We can also compare returns to the typical wealth manager's mixed investment portfolio, and those are up about 54%, so similar, slightly below the sort of typical mixed investment fund. In general, we're pretty pleased with how we've performed against the competition, if you like, but of course the important thing is making sure your portfolios grow in real terms. Now, as we know, inflation has been pretty high recently, and that makes this more challenging. And over 10 years, inflation has averaged about 3.3%. But that means that all the portfolios have therefore grown in real terms too. And if we compare that to your typical cash return, where an account paying base rate would have returned about 1.7% per annum on average, that's below inflation. So as usual, I think it's really important to remind ourselves just why it is so important that we invest to see our money grow over the long term. So now we're going to look at how portfolios are positioned and how we've been adapting that given everything that's going on that we discussed in the first video. So this table shows the asset allocation of our balanced portfolio, and it also shows what the asset allocation was a year ago and how things have changed. So we're going to start by looking at fixed interest and cash. And we've reduced exposure to these asset classes over 12 months, partly because interest rates have been cut, and that means yields and bonds have gone down a bit as well, and that makes it somewhat less attractive. We still like parts of the fixed interest or bond market. Particularly we like shorter dated corporate bonds, which we think offer a really good yield, but lower risk because of the short time to maturity. However, we've reduced exposure a bit, and much of that has been used to increase exposure to alternative asset classes. Now, this includes things like absolute return strategies, which are essentially funds that try and produce slow and steady positive returns, kind of almost regardless of what happens to stock markets. And we think increasing these feels like a sensible move at the moment to try and get extra diversification into the portfolios. Our exposure to real assets has remained the same, but we've actually switched out of real estate and into infrastructure over this time. Real estate has had a really poor time recently, and actually at some point I think we might consider going back in again. But instead, at the moment, we prefer infrastructure, and we're specifically invested in utilities at the moment. And that's because we think they can benefit from rising electricity demand and hopefully can also provide something of an inflation hedge, because basically electricity and utility prices tend to go up over and above inflation. Equities, you can see we've increased slightly, but that's mainly due to market movement. What we've actually been doing is trimming equities as they keep rising, and we've also introduced some hedges which may help insure part of the portfolio. So essentially things that might go up if markets pull back. We have, however, increased defined returns. So these are structured products based on the market, which will provide a fixed return at the moment around 11% per annum based on current rates, should markets just move sideways from here. They don't need markets to go up to generate the returns, and actually if markets go down, they also have some element of capital protection over the long term. So we really like these at the moment as they can provide some decent returns even if the market goes nowhere, or if it pulls back a little bit before then hopefully recovering. So there's lots going on in the markets at the moment, but in terms of positioning, we've generally kept things fairly steady. It's always a balancing act between trying to mitigate against the risks that we see are out there. So for example, stock markets have had a very good run. Could they pull back at some point? We're certainly conscious of that. But also we do want to be exposed to the stock markets, for example, whilst they're going up, exposed to asset classes whilst they're having a good run. So it's very, very difficult to get that balancing act correct. But we think we're quite pleased with the way things are positioned at the moment. We should benefit if markets carry on going up, but also some of that kind of portfolio insurance, if you like, should hopefully kick in if markets pull back and cushion some of the losses rather. And that means that we then have some money that we can use as usual. If that happens, that we can use that to switch into markets at relative lows, and then when they do bounce, we can hopefully then benefit as well. So we'll continue to watch things closely, but as usual, please do get in touch if you have any questions. So thanks a lot for listening. We'll see you again next time.